For 2 decades, I have pursued 2 goals in investing: finding market patterns that can be reused, and earning the easiest money so that capital works for me. If you share those goals, my experience and thinking can serve you. Today, I will lay out a complete framework that combines fundamental analysis and technical analysis, and I will start with a costly mistake that taught me the most important lesson. This framework is not about predicting the future, it is about building a process that respects both business quality and market reality. Let me show you how to think about a stock before you ever click buy. Before any framework, you need to define your objectives. My first goal is to find patterns that repeat, because patterns can be exploited. The second is to earn the easiest money, which means avoiding unnecessary risk and complexity. These goals shape every decision. I avoid businesses I cannot understand, and I avoid trades that rely on hope. The framework I will present is designed to filter out noise and focus on what is durable. It is not about being right every time, it is about having an edge over time. With that in mind, let us move to the first pillar, the business model. The first step in fundamental analysis is to understand the business model. Ask, what does this company do, and who pays it? Is it a business-to-business or business-to-consumer model? Does it have a moat, such as a monopoly or a network effect? Can the business scale without hitting a ceiling? If you cannot answer these questions within 5 minutes, you likely do not understand the business. And if you do not understand it, do not invest in it. A great product should have 4 characteristics: undifferentiated, widely adopted, freely priced, and monopolistic. Google is the classic example. Its search is undifferentiated, used by billions, not price-regulated, and dominant. This is the kind of business you want to own. Once you understand the business, you examine financial performance. The key metric is free cash flow, which is the cash generated from operations minus capital expenditures. This is the money the company can actually deploy for expansion, acquisitions, dividends, or buybacks. A company with strong free cash flow has flexibility. It can attack or defend. I look for positive operating cash flow and positive free cash flow. Negative operating cash flow means the core business is not generating cash, which is a red flag. Free cash flow is the true measure of profitability, not accounting earnings. Financial performance is assessed through 3 types of data: revenue, operating margin, and cash flow. Revenue should be above $1 billion, because that scale indicates a company has passed a critical threshold. At that size, a sustainable growth rate is 15 to 20% per year. If growth falls below 10%, the company may be hitting a bottleneck. Operating margin, or EBIT margin, measures core profitability. Compare it within the same industry. Walmart's 4% margin is not worse than Google's 93.65% because their business models differ. But comparing Walmart to Costco, whose margin is 3.7%, tells you which is more efficient. Cash flow must be positive, and free cash flow should also be positive. These metrics filter out story-driven stocks that lack substance. After confirming the business is sound, you must assess its market pricing, which is valuation, not the stock price. Common metrics are price to sales, price to earnings, and price to book. They all express the relationship between market value and business value. Valuation tells you about market expectations. A higher valuation means investors expect more growth. You do not need to argue with the market, you need to understand what is priced in. I use valuation as a sanity check, not as a timing tool. A stock can be cheap for a reason, and a stock can be expensive for a reason. The key is to know which is which. Fundamental analysis answers a qualitative question: is this a good business worth owning? But it does not tell you when to buy or sell. A company with excellent financials can see its stock fall for months. That is why you cannot use fundamentals alone for trading. You need a technical framework to guide entry and exit. My rule is, fundamentals are for selection, technicals are for timing. The next slides will explain the 3 pillars of technical analysis: trend, position, and risk management. Remember, the best business in the world is a bad investment if you buy at the wrong time. The first pillar of technical analysis is trend. I visualize trend as the direction of a clock face. 1 o'clock means the market is extremely bullish, almost manic. 2 o'clock indicates strong approval and optimism. 3 o'clock shows hesitation and doubt. 4 o'clock signals pessimism. 5 to 6 o'clock means extreme disbelief. Trend acts as a bridge between known and unknown information. If a company's fundamentals look great but the stock is falling, the trend is telling you that something is wrong that you do not see. Do not fight the trend, respect it. I prefer to buy stocks that are in a 2 o'clock trend, where fundamentals and price are moving together, because that alignment is the easiest money. The second pillar is position, which refers to historical fair prices. On a chart, volume is often shown as a vertical distribution of trades at different price levels. When a large volume of shares has traded at a certain price, we call it a chip peak. That peak represents market consensus. Many investors believe that price is fair. These chip peaks act as support in uptrends and resistance in downtrends. When a stock pulls back to a major chip peak, that is often a safe place to buy, provided the overall trend is up. Conversely, when a rally hits a chip peak, it may stall. Understanding these levels helps you time your entries and exits with the market's consensus. The third pillar is risk management. Every trade must have an expectation and a bottom line. The bottom line is your risk boundary. Most losses in the stock market come from not having a stop loss or from refusing to admit a mistake when the stop is hit. I learned this the hard way. Years ago, I held a stock that kept falling. I believed my analysis was right and the market was wrong, so I held and even added more. 2 quarters later, the financials proved I was wrong, and management had made serious errors that were not public. I eventually sold at a huge loss, and the stock never recovered to my entry price. The lesson: when the chart contradicts your expectation, respect the chart, because it contains information you do not have. I thought I knew the company better than the market. The price kept falling, but I held on. I added more as it dropped, believing I was right. 2 quarters later, the financials proved me wrong. I sold at a huge loss, and the stock never recovered. Now, let me put it all together. The fundamental framework is the strategic layer. It tells you whether a business is worth participating in. If the business is flawed, do not even consider the trade. The technical framework is the tactical layer. It guides your actual entry and exit. Sun Tzu said, "Know when to fight and when not to fight, and you will be victorious." And the skillful warrior wins first, then goes to war. These principles apply to investing. You need a strategy that avoids bad businesses, and tactics that time your trades with the market's consensus. Only when both align do you have a high probability trade. Finally, every trade must follow the 3+1 principle: have an expectation, have a bottom line, have a plan, and then execute the plan. This principle is the key to unlocking wealth, and it applies beyond investing to all aspects of life. Without a clear expectation, you are gambling. Without a bottom line, you risk catastrophic losses. Without a plan, you are reactive. And without execution, the plan is useless. I have seen too many investors skip one of these steps, and it always costs them. This discipline is what separates successful investors from the rest. In summary, a complete investment framework combines fundamental analysis for business quality and technical analysis for market timing. The fundamental side asks, is this a good business? The technical side asks, is this a good time to buy? And risk management ensures you survive when you are wrong. My 20 years of experience have taught me that the market is a powerful information aggregator. Respect it, but do not be enslaved by it. Use this framework to build your own process, and remember, the goal is not to be right, but to make money consistently. I read them all. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.